Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning, ladies and gentlemen, and warm welcome to all of you watching us from many different parts, not only of Europe, but from around the world indeed. We have more than 800 registered participants, and obviously this live stream will also be later made available for replay to anybody who was not able to watch it. It's the last episode in our Focus On series, and as has become the tradition, the last one in the year, we dedicate it to the next year, Focus On 2023. Thus it is today that we are focusing on. We have learned, if anything, over the last couple of years that making predictions is a very, very difficult sport, especially when they are about the future. We have learned a couple of years ago that suddenly a pandemic can completely upend the way we live, the way we work, the way we interact as society. We have, unfortunately, even more dramatically learned this year that war is not something that is theoretic or distant. It can, unfortunately, very quickly become something that is all too real and dramatic on a human scale. Also, the economic consequences. That is what we will focus on today. We will start with a first panel with eminent experts that I will introduce in a minute to look at the macroeconomic and the geopolitical situation, what to expect from 2023. Obviously, we will look at how far can we actually make predictions, what lessons do we learn from the past, what is happening to the world, where in fact is the world going in 2023. Besides everything we have learned in the last year about the importance of macroeconomic and the importance, obviously, also of geopolitics, there are nevertheless also two main mega trends. The first one is sustainable finance, and the second one is digitalization. We will look at these two trends in a second panel discussion with two phenomenally competent ladies that I will introduce once we get there. Now, ladies and gentlemen, the first panel, where is the world going in 2023? To discuss this question, where the world is going, I am joined by a stellar cast of speakers, and let me introduce them one by one, starting obviously with the lady, Elisabeth Krecké, who has joined us digitally. Elisabeth is an independent economic advisor. She currently works for Geopolitical Intelligence Services, a consultancy company and an information platform that provides geopolitical analysis for strategic decision makers. Elisabeth has been a university professor at, of course, what is the best university you can ever attend, which was my alma mater in Aix-en-Provence. Very wise decision to spend many years there, where she also has obtained a PhD. Then we are joined by Noel Fessey. Noel is a long-time investment fund professional, having spent the better part of this century at least in the investment fund industry, leading first of all Schröder's in Luxembourg, and then over the last several years, since 2017, EFA, the European Fund Administration, which you have now successfully channeled towards the Universal Investment Group, and that makes that you are now more independent and can enjoy a different life where you look at becoming independent director and making your expertise available in the non-executive role. Noel has also had a long stint in the British Army, 13 years as an officer in the British Army. Then we are joined by Yves Nobusch, who's a regular to this program. He has been with us actually for the two first editions already in 2021 and in 2020. That will allow us also to revisit some of the discussions we have had over the course of the last years. Yves is the chief economist of BGL BNP, the Luxembourg affiliate of the BNP Paribas group. He's also in charge of CSR and strategy for the bank here in Luxembourg. He, before joining BNP, was on full-time faculty staff at the London School of Economics, where he also graduated, after which he got a PhD at Harvard University. And then, last but certainly not least, Bruno Rovelli. Bruno is Chief Investment Strategist for BlackRock Italy. He is also a member of the BlackRock Investment Institute and has more than 20 years of experience in the investment management industry. Bruno, like many Italian economists, and has a degree from the Luigi Bocconi University in Milan. Ladies and gentlemen, and with these speakers, allow me to dig into where we are today. If I, as I said, take a step back and look at where we were a year ago. A year ago, we were relatively optimistic, if I may say so, coming out, as we felt it, from the pandemic. Still some bottlenecks in supply chains and other restrictions still applying, but nevertheless, everything was going in the right direction. There was this little pesky issue of rising prices, but everybody agreed, in particular the European Central Bank, but all the economists followed the predictions of the European Central Bank by saying this is a merely temporary phenomenon and will soon abate. If I may turn to Yves, as you were part of the gang last year and part of the chorus that sang this hymn, what did we get wrong? How did we get it this wrong? And what do we need to do in order to get it right?
Yes. So thank you very much, Nicolas. So first of all, I had a feeling you might bring this up. So it's true that most economists and most professional forecasters basically underestimated, I think, even before the Ukraine crisis, how quickly second round effects would take hold. So how quickly we'd get spillovers into, from the initial shock, which was energy prices, some supply bottlenecks, how quickly this would spill over into other sectors and also into wage inflation. So I think that was the basic mistake. Now, of course, the Ukraine crisis, the war in Ukraine has, of course, made it worse. And now what we've seen this year is a significant rise in core inflation, that is inflation that excludes energy and food prices. I should say, however, that not everybody got it wrong. So in Larry Summers in particular, professor at Harvard University, he basically got it right, because he basically warned as early as early 2021 that central banks and markets were vastly underestimating what it would take to bring inflation back to target levels. So he was the odd one out who got it right very early on.
Okay. Bruno, you also as an economist, what do you make of the predictions we made last year and how wrong everybody was on this?
So yeah, I think we need to put that a little bit into the context. So this was not a normal recovery. It was really a reopening of the economy, the one that we had after COVID, right? So it's like we've frozen the economy and then we reopen it. And so I think we thought that COVID was a symmetric demand and supply shock, so that both were hit at the same time. And that was temporary, and that actually proved true for demand. So the demand that you didn't do while you were shut down, actually you did it when you were released. The problem was on the supply side, and the supply took much longer to adjust. And there are cyclical and structural reasons for that. I think overall, we saw the structural reasons, but we probably kind of downplayed that in the short term. And the cyclical reasons for that actually proved much, much stronger. And so what comes now, I think, is that the cyclical part is improving because demand is slowing down. But some of the structural issues that has made inflation higher, I think are still there and will not disappear very soon. So in general, I think that the fact that this was not a normal recovery is something that we should kind of take into consideration, and was very different from any historical experience that we had in the past. And how many times in the past did we reopen an economy? I mean, it really never happened. So there was not a lot of historical experience as well to look at.
So Elisabeth, you want to come in.
Yes.
Maybe we will also discuss what do we expect in terms of inflation in the coming month. But Elisabeth, please go ahead.
Yes, very briefly. Just also to this question, why did policymakers get it so wrong during so long, is maybe also that they haven't experienced it personally. We haven't had inflation for so many decades. So people somehow no longer know what it does to us, what is exactly, it's difficult to grasp. And indeed, you were mentioning Larry Summers, and he was totally right. And what he was saying also, he was predicting an inflation in the US that is largely demand-driven, that is linked to an excessive domestic demand, which is itself the consequence of an overly generous stimulus policy that was conducted by the Biden administration during the pandemic. So the government pumped so really literally trillions of dollars into the economy, and that makes, of course, an upward pressure on prices. Whereas in Europe, we have a different kind of inflation, even though there has also been stimulus and there was all this. But a large part is due to an exogenous shock, the energy shock. So the question is also that I'm asking myself is, will the same solution be applicable in the US than in Europe? In the US, obviously, tightening the screws of monetary policy could work. Raise interest rates, withdraw the stimulus, and the purchase asset programs. But in Europe, obviously, the ECB had no choice but to lift the interest rates. It had to get rid of these negative rates, obviously. But the question is, will it work? Will the solution be the same than in the US case? So that's also a problem. Inflation is so difficult to grasp, so difficult to understand as a phenomenon, I would say.
Good. We will come to the monetary policies and compare the US versus Europe in a few minutes. Let us still stick a little bit with inflation and look out into 2023. Obviously, one of the major drivers of the rise of inflation over the course of this year was the energy shock, as you also rightly said. We had seen energy prices starting to rise as early as summer 2021 already, and then obviously with the invasion by Russia of Ukraine, even more. Where are we going on inflation in 2023? I don't know, Yves, if you want to start. What is your prediction and on what will we base it?
Sure. So maybe just to start with, where do we stand now? So basically in Europe, the latest numbers on headline inflation, which includes all price categories, were around 10%. This has come down a little bit since October, from the peak in October. Core inflation, which excludes food and energy, we are at around 5% in Europe. In the US, we are on the headline inflation, we are just above 7%. And on the core inflation CPI, we are just below 6%. So I think we can expect that headline inflation is going to come down significantly next year due to base effects related to energy prices. But I don't think that's the key question. I think the key question is going to be what happens to core inflation, which is quite high, which is very high in the US, 6%, in Europe around 5%. And that means inflation is widespread across, not just related to a few categories, as I mentioned at the beginning. And I think that's going to be harder to get that back down to target quickly. So overall, I think we'll see a significant drop in headline inflation next year. The key question is going to be how quickly is core inflation going to come down?
And even if inflation comes down, it will come down at very high prices, very high levels of prices. Bruno, Noel, please.
There is, I think, in a lot of this discussion, and it maybe is partly the question of why were the predictions so wrong, is there is a certain orthodoxy, which is that we have come to expect inflation to be within the bounds set politically for central banks to match, so 2% or so, and that has become our expected outcome for a very long time now. We are, in a sense, rolling back to a period in the 70s and 80s when inflation was sustained at 5% plus 10%, even 25% in some places, or higher. And I think the orthodoxy of the expectation that it will reduce back towards target of 2.5% is, if we expect that to happen, we're likely to be disappointed in 23 and potentially beyond. And I think partly because some of the things that we talk about in this conversation, such as an energy shock arising, for example, from Russian, the absence of Russian energy as a European source, is not a short-term thing. It's a secular thing. Energy imbalances started to become significant in 2019. Oil demand started to exceed supply. OPEC did not provide more. And this has fed through our economies for a lot longer than just the pandemic or the war. I think the war will exacerbate it going forward. So I think some of the fundamental political and geopolitical factors driving inflation expectations will be different from the great moderation that we saw over the past 15, 20 years.
Mm. You mentioned the war. Maybe Elisabeth, from your vantage point as a geopolitical expert, is there any positive scenario on the horizon? Do you see any short or medium-term end to it, so that there can be some sort of end to the suffering first of the Ukrainian people, but also that we get back into more normal ways of dealing with things?
Well, I think that is a question that is really impossible to answer. For the moment, nobody knows what is going to happen. There's really one word that applies here, it's radical uncertainty. But you are right, this question of determination is so important, and I think it will be a key question in 2023. And it is not just only when can this war end, but how is it going to end? And obviously, as you say, something positive could happen tomorrow. If Russia decided to stop, that would be so easy, but we know that this is not going to happen. Last week, there was an interesting interview in the Financial Times by Jens Stoltenberg, where he said, the option that is not possible is the one that we let Russia win. That would be the other one, because, but that would not be possible, because if Russia wins, that would be for Ukraine a disaster, but for the world as well, because if Russians get away with it, that would mean they would do it another time for another nation. So the only way out of this is a negotiation table. And Stoltenberg said clearly here, and that is different from what the other political leaders are saying right now in Europe, for instance, Olaf Scholz or Macron, they want to be involved in that. But he says it's only the Ukrainians, those who are victim of this aggression, who can decide when and under what conditions. But what we see, obviously, Ukrainians are not ready for that, because there's still too much anger. The wounds are so deep. And also there is something, if they go on the negotiation table, there is a credible commitment problem. How can we trust Russia? And indeed, last week, Vladimir Putin said he is ready for an agreement on a ceasefire. But how can we not think that he needs time to rebuild his battered troops and maybe invade Ukraine with more forces in spring? And maybe he's also hoping for a fatigue in the West of that war and so on. So there is really a problem. And then there's the other big problem. As long as Russia is reiterating this threat of nuclear escalation, which they do regularly, we don't know whether this is saber rattling or whether they will really go through with this in spite of the cost that this would have for Russia itself. And I think, honestly, as long as there is something like that in sight, I don't see an end in sight either. So it's all open. It's literally the fog of war.
Yep.
That's what my impression is about this.
I agree with that. I think it is going to be a long war. There will be no termination in the short term, and this will probably run fully through 2023 and possibly beyond. I think it's understandable that Ukraine at this point sees no terms upon which it can settle, or rather, Ukraine's demands will be unacceptable to Russia. Russia's demands are unacceptable to Ukraine. And the way that these two sides will explore the possible termination zone, the grounds for settlement, is by continuing to fight until they fully understand one another's fighting power. And this is more than just talking about the Ukrainian armed forces, it's also testing the economic and military and political will of NATO and those who support Ukraine, and similarly those who support Russia. And so there is no easy way to find settlement terms. And I think one of the key things to understand is that there is more likely an escalation than there is a de-escalation in the medium term. Because Russia in particular has no exit route except through escalation, at least to apply more pressure, particularly on the West, until the West starts to put pressure on Ukraine to seek terms. And this is where energy comes back in again, but not just energy. You know, we tend to think of the battlefield at the moment as being Eastern European, the territory of Ukraine. I think one of the most interesting and perhaps underreported aspects of conflict between the two sides at the moment, and I'm not talking about direct belligerents, but those supporters, is the North Atlantic and submarine warfare, which is an extraordinarily busy place at the moment. And if we think that that's not relevant, then we should understand the nature of interconnects, and we saw Nord Stream 2 being damaged, but the nature of other interconnects across the Baltics and across the cables for communications, for electricity and for gas. And these are all in play. So are other elements of critical national infrastructure. So this war can go up and out far more than it can settle in the next year.
Okay. Well, on this happy note, no, we all knew that we cannot build our equation on Putin withdrawing. That is simply not a realistic scenario. We do not want any of the other scenarios. I think our resolve to support continue supporting the Ukrainian people is unrelenting. But then, yes, on the basis of what we have just now discussed for the world economy, what are we to make of the future of monetary policy in this context? We touched on it before. Elisabeth also hinted at the different reasons for inflation in the EU and in the US. What are we to expect from the Fed or the European Central Bank in terms of monetary policy? What will it mean for a possibly looming recession? Maybe Bruno, if you want to take this.
I mean, it's quite clear that right now, central banks are really focused on fighting inflation, but we also need to recognize that overall economic growth has been pretty resilient. So that has been the case in Europe, has been the case in US. So I think the economy has not slowed as much as maybe people was expecting. And so it's been somewhat easy for central banks to remain focused on fighting inflation. However, as growth slows and the politically sensitive labor market weakens, central banks will become more nuanced. And they have already started to some extent to become a little bit more nuanced. What is relevant anyway is not only if they become more nuanced, but what they do after. And here, we think that the historical playbook will not apply. So if you look at history in the last 20 or 30 years, I mean, you had an economic slowdown, and then central banks came to the rescue, cutting rates relatively soon. And the reason for that was because inflation was stable. And so when inflation is stable, the only thing that matters is demand management. And now that inflation is actually not as stable as in the past, I think the situation is slightly different than the historical playbook. So next year, we're going to have a lot of economic slowdown, but we think central banks will be very, very resistant to do anything. So they will stop hiking rates, we think, in Q1 of next year, but they will do very little to compensate the economic weakness or even recession that we expect until they feel more comfortable with the inflation dynamics, which we think will not happen before the first half of 2024. So there's different stages in front of us. First one is they recognize that the economy will slow. That will mean that we will stop hiking rates, but then they will not do what we normally did in history. As demand slows, cut rates. I don't think they will be doing that. And this is a big difference versus what we experienced in the last 30 years.
Yves, what do you predict between the Fed and the ECB? Will they continue hiking rates at different levels, or?
Yes, I broadly agree with what Bruno said. So in terms of our forecast, so we think they will continue hiking into the first quarter of next year. If you look at the ECB, they have so far cumulatively hiked by 2%. We think they will hike by another 1.5% by the end of the first quarter.
In total.
Yes, right, exactly. Possibly 50 basis points tomorrow. That's roughly what the market is expecting. For the Fed, again, we expect them to continue hiking into the first quarter of 2023. They have hiked so far a cumulative amount of 3.75, and we expect them to hike in total by 5%, so another 1.25, possibly again 50 basis points in the meeting that is taking place as we speak.
What does that mean for recession?
So maybe just before I get to the recession, I also agree with Bruno that we also think it's unlikely that the central banks will cut rates if we get a recession. So we also don't see any rate cuts at least until 2024. Now the question of the recession. So as Bruno has said, growth has been resilient. So we had the latest number in Europe. The Q3 GDP number was better than expected, and this has been somewhat of a trend over recent months. And so the consensus today seems to be that we will get a mild recession both in the US and in Europe. That's what's priced in. That's what most forecasters expect. And so I may go back to Larry Summers, because Larry Summers has a view on this as well. And since he was right 2 years ago, it might be worth listening to him this time again.
You spent too much time in Harvard.
Maybe that's maybe another reason. But anyway, I like listening to him. So he has written a nice article end of October, where one of the things that he points out is he says his view is that it's difficult to see how inflation, he's talking about the US obviously, how inflation can be brought down to 2% without unemployment rising above 4.4%, as is implicit in the Fed projection, which is essentially based on a mild recession in the US. So again, the key question here, are we going to get, especially core inflation, I get back to what I said at the beginning, which is currently at around 6% in the US, 5% in Europe. Are we going to get that back down to 2% by just having a mild recession?
That would confirm Noel's scenario that we would have 4 or whatever other level of inflation as the new normal. Yeah. 4 is the new 2. Is that?
Well, no.
That's.
I think. Well, that's an interesting debate. I think at the moment this is not what the central bank's messages are. Clearly, the central banks have the intention, and they're very outspoken about this, of bringing it back to 2%. There is a long-running debate also in the academic literature in central banking circles whether 2% is the right target. But that's sort of at the moment that's not really officially debated. So the official target remains 2%.
Okay. Bruno, you agree with that?
It's probably important also to notice that central banks undershoot the 2% inflation target for several years. And they still kind of say that their target was 2%. So it's not inconceivable at all that they will overshoot for several years the inflation target, still saying that the inflation target is 2%. So that's actually our view, that they will accept ex post an inflation which is higher than 2% when they realize that the cost of bringing inflation really to 2% is really very high, not only in terms of recession, which is a story for next year, but also in terms of how much you can allow the economy to grow even after the recession. So some of the structural forces that I mentioned before, which is like geopolitics, is like aging population, is even the net zero transition, they all add to inflation, and there are structural forces to which central banks can do very little against. So that's our view, that they will eventually ex post accept, especially true for US. So Europe is a slightly different story. But US, we think they will accept higher inflation ex post, as they did accept a lower inflation ex post for several years.
So Elisabeth, and then we move on.
Yes, very briefly, if I may comment, we haven't talked about the debt problem. I think that is also something very important in many Eurozone countries. We have very high household, corporate, and above all, government debt ratios. And we have also something that didn't exist in that amount, at least a few years ago, that is the European Union common debt to programs such as SURE and now Next Generation EU and so on. So a lot of debt is floating around in the Eurozone. And so obviously any rise, any hike in interest rates could make indeed the recession much worse than one might imagine. And I found very interesting what you were saying about the 2% target of the ECB and also the Fed and the debates that are now coming up, maybe a change of narrative. Should we move up this goalpost to 4% or something? And you mentioned Larry Summers. It's interesting that he and his co-author, Olivier Blanchard, a few years ago would say we should lower the goalpost maybe to 1%. Those were the years where the ECB systematically undershot the target. And so it's kind of interesting to see how narratives also change in macroeconomics these days.
Yeah, Olivier Blanchard, if I remember correctly, was the gentleman who only 2 years ago recommended that every state raise their debt levels because it was so cheap to borrow.
Exactly. Exactly.
Anyway, let's not go there. No discussion on the current geopolitical and macroeconomic context would be complete without adding a bit of Chinese flavor to it, because we very well see that the world is complex as it is, but the tensions between the US and China certainly will add a whole new level of complexity to it. Maybe Elisabeth, what can you make of the growing tensions, the chip war that has currently broken out between the US and China, what is perceived to be a growing nationalism and militarism of our Chinese friends concerning, in particular, Taiwan? Where is this going, and what does it risk meaning for the global economy?
Well, I think that is a very important question. Here we have probably one of the most important geopolitical issues besides Ukraine in the world, this chip war. Indeed, China, there is really a Cold War going on between China and the US for years, after years of trade wars and above all these tech wars. And there's one country in the world that today produces something like 90% of the most sophisticated cutting-edge semiconductors, those that are at the heart of all our technologies, be it military, medical, automobile, our smartphones, everything runs on these microchips. And this little island, Taiwan, China claims ownership on it, wants to reunify with it. So if something happens to Taiwan, it will be critical for all technology for the rest of the world. And now for years, China has tried indeed to catch up in the production of semiconductors, but it is obviously something that is extremely complicated to have the machineries to do that. There are only few companies in the world who have the machineries to allow to do that, and obviously China is not in that loop for the moment. There's one book that has come recently out a few weeks ago, only by an historian from Harvard, Chris Miller, who explains very well how complicated that is for China and how many efforts they have made to catch up, and they are on the path of catching up. But now, last August, the Americans have signed into law what they call the CHIPS Act. The CHIPS, C-H-I-P-S Act. That means credible, helpful incentives to produce semiconductors and Science Act. This CHIPS Act, combined with very strict export controls from the American side, have as objective to literally freeze China behind, years behind, in the chip industry, in the chip technology, but not only, also in other leading edge technologies such as artificial intelligence, nanotechnologies, quantum computing, and clean energy. And this was for China almost as a declaration of war. And it could have led to a retaliation of China. They could say, well, if you freeze us like this, well, then maybe we would get Taiwan, and then the chip technology is ours. So, and that is something very problematic, because in no time, the Cold War between the two countries could escalate into World War III. Again, we can say, because we have this problem already somewhere in the distance with Ukraine and Russia. So, but imagine this is a very complicated situation. And therefore, the recent meeting before the G20 was very important between Xi and Biden, where they were having a long meeting, and obviously they tried to calm down. It was really a meeting of appeasement, of détente, to get things somehow not spiral out of control. But you are right, this is really a very important geopolitical issue right now.
Yeah. Let us certainly hope that the Marshall scenario would never materialize. And one thing that nevertheless we see already materializing from these tensions is an increased fragmentation, if not of the world yet, at least of markets, leading to what some call friendshoring, and with that deglobalization, at least as we knew it. If we try to understand what exactly does this mean for the global economy, what does it mean for the world of investment, what are we to make of this deglobalization and this friendshoring for the world of investment? Didn't the world of investment grow and benefit everybody by being able to connect investors from one geography with projects in another geography? Didn't it help to create not only growth but also jobs all around the world by investing pension funds money into companies in the opposite side of the globe? Are we revisiting that? Are we rescinding that? Maybe Elisabeth, if you want to...
Yes. Yeah, I think that is really very, very important question, this retreat from internationalization. And I think this is exactly what is going to happen, a sort of polarization, balkanization, new iron curtains in the world of finance, when the Cold War enters the world of finance. Indeed, that reduces very much opportunities for investors, but at the same time, they have no other choice. In a world of chaos, in a world of danger, trust becomes very important. And now you cannot trust so much anymore. So now you see, indeed, investors prefer remaining in a geographical scope that they somehow control. And I think that is going to last for a long, long while. And also there's something else that comes into play, I would say, among investors, is now they want to take position in those conflicts. They don't want just to say, well, I don't know where the money comes from and where it goes to. That is something now markets value this. It's almost for companies a part of the management of reputational risk. you are sensitive to these issues. Like, for instance, after the Ukraine invasion, many investors withdrew their investments. Of course, because they were fearing for the security of their investments, but also because they didn't want to get involved in these things.
Yeah. Some of them got stuck in it, and I think that also serves as a lesson. Does anyone else have a comment on the issue?
Maybe if I can say something of this. So we need to understand what geopolitical fragmentation means. That means that basically geopolitical objectives or political objectives become more important than economic objectives. That's everywhere in the world, not just in China, everywhere.
Exactly.
And so that actually means that the profit maximizing kind of exercise, which has been the one that has led the sustained bull market of the last 30 years, will become more complicated. So we think that there will be higher volatility in the business cycle, higher inflation, more growth volatility, and probably the long bull markets in risky assets that have characterized the period of a great moderation since the late 80s, since the early 80s, that's probably over. So we're probably in a world where if geopolitical objectives are prevalent versus economic objectives, you need to accept that as a cost in terms of growth, inflation, and probably also in terms of financial market ability to deliver long-lasting bull markets.
Okay. Before we wrap this up, because time is running out, let me maybe ask one more question. And that is, I read last week an article on Bloomberg, and I was very surprised by it, by the optimistic tone it struck. They interviewed a range of different investment managers about the prospects for next year. And apparently the consensus was that equities would grow by double digits. I was surprised by that, but maybe, I don't know, Yves, if you share this optimism or how you look at it, is that something you would sign? Don't worry, I won't ask you again next year if you get it wrong.
I don't want to particularly comment on our outlook for the equity markets, because that's our investment strategist. It's a different, and it's very sort of, it's obviously very tricky in the current environment. Maybe what I can just say is, conceptually, it's a very interesting question right now, because it obviously depends a lot on what you think about recession risks and how deep the recession is going to be. And it goes exactly back to our previous discussion, and how much more you think central banks will raise interest rates. Because if you get a deeper recession than what the market expects, you're going to get earnings disappointments. That's the numerator in the stock valuation. And if you get more rate hikes than the market expects, that will also have a negative effect in this case, through the denominator of the valuation ratio. So your outlook on equities is fundamentally linked to what you think is how deep the recession is going to be, and what you think the central bank's stance is going to be in the face of such a recession.
Bruno, you as investment strategist for BlackRock, I have read recently the excellent presentation by the BlackRock Institute on the outlook for 2023. That is not necessarily a view. The Bloomberg article view is not necessarily one you would also sign up to, or are you this optimistic?
No, that's correct. I mean, basically, growth was low next year, inflation was low, policy is going to become tighter in Q1 and then stay on hold. So it doesn't look like this is a great environment, right? So you're going to have a slowdown in earnings growth, also pretty material probably, and you don't have the normal help from policy that you had in the past, right, when you had this kind of slowdown in growth. So I think we are more on the cautious side, especially for equities, while maybe we get a little bit more of reward in some fixed income assets next year, especially if growth slows materially, like corporate investment grade. So in general, lower nominal growth is good for fixed income and is not very good for equities. We think there are nuances around that, but generally we are not kind of very bullish on equities right now. We kind of prefer to take risk in, let's say, kind of relatively low risk fixed income like corporate investment grade or the short end of the curve, for example.
Good. we will have to wrap it up in 30 seconds. Maybe if I can ask each one of you to give me one reason for optimism for 2023 after our 45 minutes of relatively somber assessment of the situation. Elisabeth, do you have any reason to be optimistic for 2023? Please be short.
I'm not very optimistic for 2023. There are many problems.
That's not the answer I wanted to hear.
Yeah.
No, but
hopefully we get out of the tunnel vision that we had before for many aspects. Maybe that is what we have learned from all that, yes.
Okay. Bruno?
So we are going to have less of a negative shock that we had this year, I believe. So we're probably going to see some of a byproduct of these shocks. But I mean, Fed has been tightening policy as never since 1982, with a huge energy shock. So I think it's unlikely, it's almost impossible we're going to have the same magnitude of negative surprises next year. So that's, I think, is something which is probably the positive thing about next year.
Okay, think of what Noel said about the cables in the Atlantic and what Elisabeth said about escalation. Sorry, gentlemen, Noel, give us a good reason to be optimistic.
Positivity first. 2009 was far better than we thought it would be or could be when we were in the middle of 2008. But I'm a bear, and so I'm going to quote somebody who spoke to us at our ALFI conference in London, Helen Thompson. And her final words on stage were the energy problem is the everything problem, and there is no way out.
Okay. Yves?
I think there's huge amount of uncertainty related to geopolitical risk, and so so there's lots of things we don't know. But I think that the one positive thing that I think we can be pretty certain about is that everything that's happening will accelerate energy transition. And I think that's, for me, a very positive thing, and that I'm very confident about, that that's going to happen next year and the years beyond that. And so that's, for me, at least one clearly positive thing.
That's also not only important for energy transition, it's also a very good transition to our next topic. So Elisabeth, Bruno, Noel and Yves, thank you very much for joining us and making this really a very lively and a very enriching debate. We will welcome in a few seconds the two next speakers, and I wish you all, the four of you, a very happy end to this somber year, and hopefully your predictions will not necessarily turn out to be right. You will have a very good and successful, but in particular and most importantly, a very healthy year next year. Thank you very much for your contributions.
Thank you. And all the best to all of you as well.
And we are back, ladies and gentlemen, and this time with two, as I said, eminently competent ladies to address what hopefully will become a very optimistic discussion after this more somber assessment of the economic and the macroeconomic and the geopolitical situation. I am joined here by, first of all, Shiva Dustdar. Shiva is the director of the European Investment Bank Institute. We will hear probably more about what exactly the Institute of the EIB does. I take it that everybody knows the European Union's climate bank, but some elements on that will also help. Shiva has spent many years now at the EIB. She was in particular in charge of the Innovation Finance Advisory Division, which of course comes in handy when we will start discussing digitalization and also sustainable finance. She has a long career also before that in finance, JP Morgan and Fitch Ratings Agency. She is a graduate from London Business School and holds a master's from Columbia University in New York. And then we are joined by Julie Becker. Julie is the CEO of the Luxembourg Stock Exchange, has taken on this charge last year in April. Before that, she was the deputy CEO. She had joined the stock exchange in 2013 after a remarkable career in banking, central banking, and many different positions that made her gain an experience which certainly came in handy when she was put in charge of the stock exchange. Her biggest claim to fame, I think we can all agree, is that she was the driving force and the founder of the Luxembourg Green Exchange in 2016. Something that certainly has largely contributed also to Julie being recognized yesterday evening, ladies and gentlemen, as Luxembourg's most important economic influencer by Luxembourg's leading business publication, Paper Jam and Delano, at an evening in front of 1,000 people. Julie, our heartfelt congratulations for this very well-deserved recognition.
Thank you very much, Nicolas.
So, ladies, let's get on to our work. We are looking at the future of finance, and as I said in my introduction before, we would like to discuss two of the mega trends. The first panel was on macroeconomics, geopolitics. While the world is going to the dogs, we still have quite a lot of other really important things going on. One of them is, of course, climate change, but we all know that sustainable finance is not only about fighting global warming, it is also about many other objectives that we're trying to achieve in the acronym ESG. There's also the S and there is the G. We will talk about that in a minute. And then, of course, the other mega trend of digitalization. But let's take them one at a time. And as you heard before, Yves was helping with the transition to this panel by suggesting, I hope rightly, that there is maybe one silver lining in Putin's war of aggression. It is that Mr. Putin will have managed to force us basically into a future of renewables. Is that an assessment that you share? Maybe Shiva, if you want to start.
Sure. Thank you very much, Nicolas, and great to be here. And also my congratulations to Julie, indeed, for last night's recognition. So, indeed, I think what is very clear is that we have realized that energy, we have energy dependence, that oil can be weaponized against us, against our interests, and hence, I think across the world, but especially in Europe, it has really now zoomed in on what we need to do in order to actually reduce that dependency. And hence, if you look at EU policy, there is Repower EU, which has really focused on accelerating investment in renewable energy.
Maybe you can very briefly say what exactly it is, Repower EU.
Yes, so Repower EU is indeed what came as a response. And of course, the EU has been has really been at the front, leading with its climate policies, regulations, as you know, across the world. It's a race to the top, which we need to, of course, hold on to, because I think we cannot sit still. And Repower EU was actually really just enhancing and accelerating that, enhancing the ambition, but accelerating the pace. Just to give it a very concrete sense, for the EIB, what it meant is we roughly put 11 billion a year into renewable energy projects, into sort of across the value chain. And for us, it meant committing to put another 30 billion in the next 5 years. So roughly, therefore, 6 billion a year in addition. And making sure that we do it so that we actually, hit those areas where we are most vulnerable in terms of the, so that maybe enhancing the connectivity, ensuring that we actually can get the transportation sorted of, renewable energy, that we deal with the intermittencies. So there's a lot, obviously, in energy systems, and you need to take, therefore, a systems approach. And when it comes to the investments, you really need to ensure that you come in early. earlier perhaps than where the private market comes, therefore take more risk where perhaps others are not well placed, but you crowd in the private capital to then take these projects so that they, scale up with speed and really, get across the whole, as I said, energy system, so that we actually decarbonize our economy on the one hand, we reduce our reliance on energy, so that's where a lot of the circular economy issues come into play. So there's a lot about it that obviously, I think the crisis has therefore, the war in Ukraine has really focused the attention that it's not about 2050 and sort of, talking about what you do in 20 years. It's about what you do actually today. And I think that's the key, perhaps, benefit.
Julie, maybe give us an assessment of where are we on the road to 2050? The impression one very often has is that we are starting to do things, but are we doing them fast enough? There was the recent COP in Sharm el-Sheikh. What was the general assessment? Is the glass half full or is it half empty?
Very interesting question, Nicolas. As you finished the precedent panel saying, can we be positive after such a somber assessment of where we are today? I would start first to acknowledge that COP27 took place in a very specific context this year. A lot has changed in 1 year since Glasgow, with the war and disaster that happened following Russia's invasion in Ukraine. We saw fossil fuel prices spike and old coal plants temporarily being opened. Also, when you mentioned it as well, just in the previous panel discussion, the renewed tension between the US and China have, of course, cast a shadow of climate cooperation between the world's top 2 carbon emitters. And of course, leaders had to, at least immediately, focus on much more immediate issues such as inflation, economic instability, or energy security. However, I think the world remains far off track to limit climate change to the agreed levels, and this is an important point to underline. The pledges to reduce greenhouse gas emission put the planet, unfortunately, on a path to heat now between 2.1 and 2.9 degrees, which could lead to catastrophic climate impacts. However, to be positive, I think it's by no means all doom and gloom. You mentioned as well the competition between US and China that we can see as well in a positive way, as it is also accelerating the clean energy transition. And there's a positive race, a clean energy race between those 2 countries that may benefit us all at the end. So perhaps we don't always need cooperation, and in this context, I remain quite positive.
Well, competition has always been good for the market, as long as it is fair competition. That certainly is the case.
Yeah.
If we look more specifically at what the world of finance can do to help reach this target of 1.5 degrees limit of global warming, do you have any examples of what has been happening, either the EIB, maybe Shiva, do you have any of the EIB is a pioneer and a leader in this. What have you been financing as a major lender that can serve as an example?
Yes, absolutely. Now, first of all, going back maybe just to Sharm el-Sheikh, because I think certainly the level of ambition, is high, and this was a COP of implementation. Now, when you look at the financial, what is actually expected is $2 trillion every year of $2 trillion every year until 2030 to address climate change. So, we're talking of huge amounts, and therefore, there is the glass half empty because we are so far away. Now, when you look at the EIB, and it's really nice to be on this panel here with Julie, because there is, I guess, an interesting relationship between the EIB and the Luxembourg Stock Exchange. We actually did pioneer, or were the first to issue the so-called green bonds in 2007, have listed those bonds in the Luxembourg Stock Exchange. So what those green bonds have done is really actually catalyze not only a lot of private finance, but really a lot of quantum of capital. And what makes them special is the use of proceeds have to go into, therefore, what is an agreed sort of level of, what very often is now referred to the EU taxonomy on climate. So you have the EIB, however, even before that taxonomy had its very clear rules of what green means. Now, so there is, on the one hand side, we have, I would say, looked at how we finance ourselves and make sure that we use innovative techniques. And then in the use of proceeds, I think that is where I would very much highlight key areas of innovation. 50% of the technologies that we need in order to cut emissions are still mainly in the lab. So you may have heard of these breakthrough technologies, nuclear fusion, but across the chain. And, so what you need there is actually, as I mentioned earlier, you need very often the private sector to lead, the public sector to lead with a lot of early stage, both research, funding, but then coming in as the EIB, we come in with our impact financing tools where we take actually risk where the banks would not come in. And we have done that, for instance, in, if you look at, we were anchor investors in offshore wind technologies. We have financed in the past solar, panel technologies that have been more effective. And now, we are very much investing in battery technologies. Again, looking also at the strategic autonomy issues that Europe also faces. We are heavily relying in many of these areas, especially on the raw materials, to other places. So what Europe needs to do is ensure that where we can, we invest in technologies that perhaps reduce our reliance on those technologies and scale them up quickly.
Julie, do you have success stories to share with us on what the world of finance can do?
Yeah, well, I think I'm convinced, of course, that we have a clear role to play. Finance is an enabler to the 1.5 degree. We need to make sure that all financial flows are compatible with this objective. We can use also finance for adaptation and for reducing the risk of loss and damage that I didn't mention for the COP27, but that was, of course, the main outcome, this loss and damage fund that was created. And for all of that, we need money. I like, the citation or the quote from the Vice President of the European Parliament in 2018 who said... Be
careful with quotes of Vice Presidents of the European Parliament these days.
At that time, in 2018. So without money, you can dream, but with money, you can act. And that's clearly why money is really accelerating. Yeah, of course.
That's a great quote for...
That's a great quote for today, but the objective at that time was really to say, that's what we need to make sure that we can finance all those infrastructure developments that are needed to achieve the global goals. And to give you one example of a corporate, which is extremely successful, and I'd like to underline what they did, because they were once one of the most coal-intensive companies, energy companies in Europe, and they became, in the meantime, the world's most sustainable energy company and a global leader in the transition to green energy. It's Ørsted in the Nordics. And this highlights how investments can help them really shift the way and ensure a very successful transition. And finance, in this case, helped develop and construct offshore and onshore wind farms, as you mentioned, Shiva, but also invest in energy storage facilities, renewable hydrogen and green fuel facilities, bioenergy, energy as well, plants, sorry. So a lot of what other energy company could be inspired of. I cannot avoid mentioning, of course, EIB, who led the way in sustainable finance, but also the European Union itself and the European Commission, who issued, under the Next Generation EU, some green bonds to support green projects across Europe. Still the EU, but then it's not completely linked to the Green Deal and our global targets, but in terms of social financings as well and social proceeds, I think the EU again played a great role in financing the COVID-19 pandemic and really helping to protect jobs and workers across Europe under the EU Share program. This is another, I think, meaningful example.
Shiva, you want to comment on that?
Yes, I was just, because we are talking about mitigation right now, and I think COP27 being in Africa was also a lot about adaptation. And looking, therefore, into the future and where we really need to rethink finance, where I think a lot of us will be quite challenged on how to actually have the right financial solutions to protect our nature, to actually have instruments that allow us to, to have bankable projects or investable projects for countries to adapt to basically the consequences of climate change. And I think, Julie mentioned the loss and damages. I think this was, of course, a very important achievement to at least put it on the table, on the agenda. But of course, this is just the beginning, because you have those countries that have effectively the least contributed to the problem suffering the most right now from the consequences. And therefore, we need to really now look, how do we get both public capital crowding in private capital to help those countries and all of us to adapt. So therefore, you will hear, I think we all will hear about nature-based solutions. How do we actually finance nature, because nature is perhaps hard to sort of, where are the cash flows from nature? Well, a lot of it is about the externalities, the benefits that nature brings us that we are not fully capturing in our current economic models. And I think, therefore, as we're talking about finance, rethinking finance, we absolutely have to look at it from a much bigger perspective. How do we actually set up new ways of valuing nature, valuing our assets, accounting for that? So it goes way beyond reporting, which a lot of the issues have been on sustainability.
You say we should take a broader look at the whole thing and rethink finance. We've discussed now quite a lot and extensively climate finance, but as I said in the introduction, sustainable finance is of course about much more than, I'm not going to say just climate finance, of course, but it's also about, for instance, social finance. Will we, now that we have a relatively good framework in climate finance with the taxonomy and the SFDR, will we also see more coming in the area of social finance, maybe a social taxonomy? I know that there were discussions that were then put on ice or so. Will that ever materialize?
Yeah, I think that even beyond discussions, you may know that last February a report on the social taxonomy was released by the Platform on Sustainable Finance from the European Commission. And I think the issue here is that social and governance are quite complex, even more complex than environmental objectives to be defined. So far, the EU Sustainable Finance Package define only minimum social safeguards that need to be respected with respect to the environmental objective, but this should be expanded. And this is extremely important, in my opinion, as we need to ensure investor protection. So they need to understand what social is about and to be well informed before investing, especially because of the high reputational risks they may face, supporting some businesses that are not in line with social and human rights value. I think the future social taxonomy will see the day soon, hopefully. At least it's in the hand of the European Commission for now. They also have, of course, to end with the 4 environmental objectives first, beyond climate change mitigation and adaptation. And I'm sure as well that they will have some elements in common with the current environmental taxonomy. But what is maybe interesting to underline is that it will be built on 3 proposed objectives that are first a decent work, and not only in Europe, but well beyond, because we need to take into consideration, of course, the value chain workers. It will be focused on the need for ensuring adequate living standards and well-being for end users. And thirdly, it will also support inclusive and sustainable communities and societies. So hopefully, I think it's important that it is regulated. It is important, again, to protect investors and to educate investors to make sure they have enough knowledge before investing in such bonds.
As you say, it is certainly very complicated to get to an agreement at the EU level, as it has been for the green taxonomy. But at least in the green taxonomy, there's at least some level of science coming into play. In the social, it's less scientific. If we then have a social taxonomy, how will that then apply across the world? Will it not also lead to much more fragmentation than already we see in the climate finance area, where the fact that the EU and many other countries have a taxonomy not necessarily the same. Other countries like the US chose to go down a route without necessarily defining what is green, but focusing more on disclosure. If we add to that mix an EU social taxonomy, how will that play out with countries that, if you look at, I don't know, we don't even need to go to emerging markets, but go to the US, they probably have a philosophically different approach to these issues than the countries of the EU have. Will that not lead to more market fragmentation?
Well, hopefully not. Of course, this is a risk we need to keep in mind. And I think the European Commission is already keeping in mind, because even in the environmental objectives with this minimum safeguards, they refer to International Labour Organization. So it's not a European organization defining what social means or what social protection means, but it's really at an international level. And in the same context, I think IOSCO as well, for instance, is also calling for all its members to promote good practices, avoiding fragmentation, and really promoting an alignment at an international level.
Mm-hmm. Maybe,
I mean,
very briefly.
Yes, no, I may just very quickly say we're talking a lot about regulation. But if you think of it, a lot of it is going beyond regulation. There will be increasingly consumers, investors, everyone will ask for certain sound principles, whether on social matters, because of just their importance and because of the problems that inequalities are bringing. So I think we shouldn't necessarily wait for now taxonomies. Certainly at the MDB levels, there has been a tradition of looking at the social impact of all their financing. So let's also, really front and ensure that all investments bring certain level of very, I think, sound approaches that are already out there into account, instead of waiting for a taxonomy that may obviously take quite a while to come in place. So I would,
Good.
and yeah.
We also wanted to discuss the other mega trend, which is digitalization. And if I may then build a bridge between sustainable finance and digitalization, let me ask you how can new technological trends accelerate the focus on sustainability, and whether 2023, that is what we're discussing, the next year, will see the tech and the sustainability agenda converge. I don't know who wants to take on.
You may have more to say. I will just say very quickly that I think sustainability concerns, and to link with what you said about the consumer approach, the investor mindset, not waiting for regulation, I think sustainability concerns is also becoming a much bigger priority for tech. So momentum is gathering around green IT, green tech, and there are two different dimensions. I think we can differentiate. The first one is that technology solution is, of course, an alternative to high-emitting activities, such as today. We are in a video recording conference. Is a greener attitude than flying delegates in from around the world. Second one is making IT more sustainable. And this is about IT itself, data centers versus cloud, being conscious of the energy consumption of screens and laptops you invest in, how we strive to reduce electronic devices waste. And those examples shows how sustainability today is to a much bigger extent becoming integrated in the world of tech. Maybe you want to further elaborate on this.
No, absolutely. So what I would certainly say, that those two are mega trends that absolutely are intertwined, and one can accelerate the other. So, just looking at digitalization, I think the crisis has really shown us the benefit of preparing and ensuring that we have the right infrastructures to enable to actually go digital. But in itself, the digitalization will again also have its emissions. So on the EIB side, what we are certainly focusing on is a lot of the investments, and this is also on the Invest EU, which is a big stimulus program, as you know, for this current budget period, so up to 27, where you're really looking at infrastructure, smart infrastructures, so that actually embed already digitalization. To give you concrete examples, think of energy efficiency solutions. They need increasingly smart metering. So we need to really invest, in those technologies that, in a way, give us both the data, but also that analyze the data, that allow us to better understand how actually to, where energy is needed, where electricity is needed, based on data. And you see now increasingly, therefore, as cities, for instance, are procuring services, they want access to the data. I know of, for instance, Barcelona, when they, anyone that provides them, let's say, service, they say, well, we would like to have the access of the data so that we can, analyze the data and actually with that create more energy efficient solutions, whether it's the lighting on the streets or what have you. And so you see very concretely how these two go together. And therefore what it means actually generally is that, we don't see like, do we now invest in quantum technologies or do we now invest in clean technologies? Well, quantum technologies are absolutely critical in order to analyze all the data at a speed where autonomous driving needs the data in order to make the right decisions, right? So it's not an either or. We have to really find ways to scale these technologies to a point where they become readily available. And therefore, when we look at our investments, whether they're infrastructure or any sort of new innovations, that tech is absolutely built in to those, and at the same time that sustainability is built in. And I think I get a lot of comfort because we obviously have a lot of these startup companies come and pitch to the EIB that the next generation of entrepreneurs just is building that, it has a mindset, tech for good, and generally, wanting to ensure that the company is ultimately, helping the planet to survive. And I think we can learn a lot from those younger entrepreneurs in how to actually, rebuild our existing economies.
Talking about young entrepreneurs and energy efficiency, we are already in digitalization and digital assets, and with that in crypto assets and so on. We wouldn't be complete without making a very short stop at the future of cryptocurrencies. We have seen the crash of FTX, we have seen the arrest of its CEO. What does this spell for the future of crypto? Anyone has an opinion on where crypto is going in 2023?
Well, I think that there are plenty of elements out of this case, and I think that, at least from the outside, I think the way the company's operations and related risks were managed played a bigger part in the collapse than the underlying cryptos themselves. So we have to pay attention not to make some confusion in this. However, what is clear is that tech needs to be regulated for sure, again, to ensure investor protection, which remains crucial, and especially because this regulation exists. It's just that the underpinning is a bit different. The tool that is used is different, but the framework should remain the same.
The philosophy of crypto was a libertarian one to just exactly not be falling under all this existing regulation.
Absolutely.
And then we have created new regulation in the EU.
But if I may add, so I think that the problems in the cryptocurrency world today should not cast a shadow neither on the underlying technology such as blockchain, because we should not mix up things, and they are also very good development, very useful development we need, especially to innovate in finance. That should not be, and no confusion should be made between the two.
Let's stay with that, blockchain. We have been, Bitcoin was more or less invented in 2009, 13 years ago, nearly 14 years ago. There are certain use cases for blockchain, but still one doesn't feel that it's really emerging. Will 2023 be the year of the emergence of blockchain? Both of you, I know, have worked on different projects on this regard, something really innovative. Maybe tell us a little bit about it.
Indeed. I think, as Julie was saying, let's really focus on the power of these technologies. And when it comes to blockchain, so what the EIB has done, and again, this is just to give a sense of how we are now embedding some of these technological innovations to also innovate, like the green bonds, to innovate and create a path. I think the role of the EU bank is also to use its perhaps position, its firepower to pave the way for others who are maybe don't have all these means to benefit. So in the case of on the bond issuance, we just a few weeks ago launched our second digital bond, and what that actually means, the bond is 100 million in euros, so we're still talking of a fiat currency, but we're using blockchain technology, and in this particular case, a private sort of technology solution, in order to effectively cut down on the long settlement times and the pretty high costs that you have when you issue bonds. That by the time. So the transaction costs can be high, therefore, very often bonds are really for the larger issuers. And here, so instead of having, 10, 12 or longer settlement days, you have it instantly through using effectively the blockchain technology. And we actually listed also this bond in the Luxembourg Stock Exchange. So I think you see also how important it is for all the players to kind of adapt and innovate and create opportunities to be disrupted, to remain in the game. Now, what this...
So if I may say, sorry,
of course.
The question is not whether it will be adopted by all and when it will be, but it's really when it will be adopted and when it will become mainstream. Especially because we also have here, and not for you as an issuer, but for banks that are used by issuers.
That was the question. Will it be in 2023?
I don't think that it will be yet in 2023 because capital markets are highly regulated. So it will be, I think it will take time and it will be done in a controlled way. But new regulation is about to come with the pilot regime in 2023. We have some regulation in Luxembourg allowing us to move fast and to accelerate this movement, clearly.
One of the things that new technology, and in particular blockchain, also allows is for the tokenization of assets. Do you see this being adopted more widely by the investment world in 2023?
I think, again, as you said earlier, we don't want to predict the future, and certainly not when it comes to these technological innovations. It's not, that just from one year to another. I think we're talking of a trend. We're
yeah.
talking of a trend. However, it can accelerate, and I think the key is, because what I found out from my colleagues who actually have been in the trenches of the digital bond, it took also a long time right now to get such a innovative transaction on the market. So this is all about learning and doing pilots. So sometimes, with innovations, you need to actually give it some time for a few of these more pioneering transactions by, a variety of issuers to come and learn from it. You don't want to now, force something to go big too quickly either. So I think let's, keep, maybe it's not maybe 23, but we're talking of something that, will, and I think this is a key. When you look at access to finance, a lot of smaller companies, Mittelstand companies, may not have been able to go to the bond market because it was actually very expensive and you needed to have sort of scale. These technologies will allow for, therefore, smaller issuers to actually tap the market, tap new markets. And this is the benefit, therefore, of digital technologies, also then to support maybe innovation, or these companies to have better access. And I think this is where we all hope to support.
I think we see more and more institutional investors investing in this new technology and adopting blockchain. What we need to pay attention to is that, of course, banks are using their own tokenized platform, and we may see a risk again of fragmentation, while we should clearly encourage an alignment of the market and potential standards to come, because the question of interoperability of those platforms is absolutely crucial.
Okay. Now, neither of you is in the business of giving investment advice. And with this caveat, let me nevertheless ask you for any comments on what trends in digitalization may attract investments in 2023. What do you see as the most promising areas in digitalization? Is it blockchain? Is it AI? Is it big data? Where do you think the smart money will go?
I think there will be spending in overall digital transformation of businesses. AI will be clearly a target investment. Cybersecurity as well is something we should not forget. I think so digital skills, so really managing human capital to adapt to digitalization is absolutely key. Well, as far as I am concerned, or we are concerned as a Luxembourg Stock Exchange, we're also investing, of course, in the digitalization of our business, but we are still looking at metaverse.
Yeah, but that we will keep for another episode. Somebody will have to explain to me the exact business case.
But you will see that
I start to slowly understand with limitations what exactly it is, but I still fail to see the exact business case for the investment world more generally. But let's not go there at this time.
No, but in one word, I think it's a new way to attract consumers.
New categories of consumers. Okay.
Absolutely.
If I may end on exactly this new category of not consumers, but also you mentioned skills, to also give it a little bit of a positive spin at the end, because we're coming to the conclusion of our very interesting discussion. What is it that you would tell young talents that are looking at different career opportunities that they should look at in trying to convince them to come work for the finance industry?
Well, I mean, to attract them to finance industry.
Finance in general.
Yes, I would say...
If finance, then obviously Luxembourg is the best option, but let's not consider that. Let's stick to the finance industry.
I would certainly say, and I think we're talking of a data economy, and therefore data sciences and understanding the value of data and how data can drive investment decisions or decisions across the board, but certainly then in finance, investment decisions is going to be absolutely critical. So what I would say, perhaps more than in my generation, having really a strong background in statistics. I mean, things that maybe were not that sexy back then, but now are renamed as...
Which is why I became a lawyer.
Yeah, data science, which maybe sounds more interesting or appealing. I would absolutely, highlight really, digital skills, understanding even how algorithms work to a certain extent will be very critical, because a lot of, we were talking about AI, a lot of decisions will actually also be automated, having some sense, some understanding of potential biases. Therefore, in a way, bringing a very strong technical background, at the same time bringing also a strong, I would say, still humanities background, because there will be a lot of questions also in finance about ethics. We didn't discuss ethics, but I think that will come into play. I mean, when it's social or under any other heading, governance, and bringing therefore that combination of skills is going to be critical. And I think the finance world needs therefore a diverse. And we didn't discuss gender either today, Nicolas, but we really want to attract a diverse group, and the greater diversity we can have, the better. And I would particularly, therefore, invite women who are considering their next career option to come into finance, because it's actually quite fun.
And Julie, why should they come into finance?
Well, I think finance is there to support the real economy that should be inclusive and sustainable, of course. So this is I think then for me it's obvious, because it's how to give you a sense of purpose, to align potentially your own convictions with the one of your employers, and to have a concrete and material positive impact in society.
Good. And on this very, very important reminder, ladies and gentlemen, yes, indeed, the finance industry's primary objective is to help finance the economy. And I'm not even talking about the real economy, because there's no difference between this economy or that economy. There is one economy, which is creating growth, and through that creating jobs and helping people put butter on the bread. That is the primary objective of the finance industry. That is what we are doing in our daily life, bringing this to reality. That is a very good way of concluding. Ladies, thank you very much for your very, very valuable contributions. It has been a pleasure discussing this with you. Ladies and gentlemen, let me also thank you all for joining us today. I would also certainly like to thank our sponsors who have supported us for this particular episode. I would like to thank our teams here, my colleagues at Luxembourg for Finance, Rovelli, who's behind the camera, but also Tatiana for the other episodes, and all my colleagues who continue to contribute to making these episodes really worth your while. And then, of course, also our production team at Broadcasting Center Europe for their contributions. I simply want to invite you to go to our website and look at the schedule of digital events that we have put up for next year, starting in January with a focus on insurance, and then followed on a monthly basis by what I hope is interesting episodes for everybody. I wish everybody a happy end to this year and a very healthy and resilient year 2023. And on this, ladies and gentlemen, thank you very much.